So Moshe, somebody handed you a $50,000 check right now and today. What would you do to build wealth with this amount of money? Can you walk us through step-by-step process for somebody listening and thinking about doing similar steps?
$50,000 is a great start for any person to start investing. I would first ask many questions. The first question would be, how old is this person? Is the money needed today, or is it something that you're investing for the future? If it's someone who's on the younger side, I always say there's 3 stages of life. The first stage, anything up until about 55 years of age, you should be aggressive. You should be putting money into the equity portion of the portfolio. Why? Because you have one thing, is time. You have time in the market, and the market over time is usually up. If the person gets closer to retirement, then you want to start building in some bonds or maybe some fixed income products. That's the second. Once you get into retirement, you want to put money that have a principal assurance with an income tilt. So this person that's starting with 50,000, which stages of life are they in? Very important though, is you should have equity exposure and constantly dollar cost average into that portfolio. When the market goes up, you're doing fantastic. When the market is sideways, you're dollar cost averaging and you're at it. And when the market goes down, which it will, you want to buy it at lower prices. So when it does come back up, you now have a lower starting point. So very important, have both equities and income, dollar cost average all the time, and the time in the market will get you to where you'd like to be. And it's important to sit down with a financial advisor and determine exactly what your roadmap is. One of the first things we do is we build a roadmap for our clients to say, here's where you are, where do you want to get to? And we build a roadmap to there, which includes taxes, children, how many people depend on you financially. It includes estate planning, all of these questions we ask.
So if you take this $50,000, how would you break it down based on what you're saying, like the products, the different markets? Is there a simple answer you can answer without getting into too much detail?
There is no simple answer, unfortunately. It is based upon each person's needs and risk tolerance. Sometimes it might be in a mutual fund. Sometimes it might be in an ETF. Sometimes it might be in individual stocks. But do know that individual stocks are a little bit harder to buy with 40 or 50,000, because nowadays so many companies are trading at $200 a share, $400 a share, $1,000 a share, that you need to have a little bit more money. So therefore, we might utilize some mutual funds and ETFs. As the portfolio grows, then we start to utilize individual stocks, and you don't have to inherit the cap gains that they already have in the mutual funds. We could talk about that on a one-to-one basis when people come see us. But there are many products out there, not just mutual funds, annuities, or ETFs. There are also great money managers out there. There are what's called structured notes. There are alternative investments, many different investment products out there. And being someone that is not burdened by one company, I can show you products, I could show you ideas from all over the spectrum. I have things that are from Morgan Stanley, from Merrill Lynch, Fidelity, Vanguard, all the different companies out there, their best ideas under one roof.
Amazing. So if somebody just moved into the South Florida area, Fort Lauderdale, West Palm, Boca, seems to be like majority of the clients you're bringing on board with expanding your firm here in South Florida. What is the usual process when you meet somebody? How many times can they consult with you before making, an action plan to actually invest with you? After somebody initially meets with you, consults with you, you put together a financial roadmap. How long does that process usually take?
The first meeting is all about discovery. We have to get to know the person. We have to know exactly what they want. What is the goal of this money? How big is the family? What are they looking to do with the family? Are they going to look to add on more family? Is inheritance important? Is insurance important? That's discovery. They need to bring us statements if they have any. They need to give us, as much information, because the information we give is only based upon the information we get.
Mm-hmm.
Once we gather all that information, the next meeting will be our roadmap and show you exactly what we think might be the best thing for you. If we agree, they take it home. If we agree, guess what? On the third meeting, most of the times, we go ahead and implement the roadmap. That could be anything with an individual account. Right now, you've got even these new accounts called Trump accounts for little children. We have new accounts, very important, called HSA, health savings accounts, where you could put money before taxes, have it grow tax-free, and come out tax-free. This is a triple tax-free investment that you can then utilize to pay for your medical bills. And if you even want to take it to the next level, pay for your Medicare when you turn 65. These are great investment ideas, completely tax-free. Just one of the many things that we speak about during that initial consultation, which is complimentary.
How many consultations can somebody have with you? Complimentary ones.
I think within the first one, we basically understand each other. And I do not charge anything for consultation. The only thing that we charge for is managing the assets. And if they would like to have a financial plan written out for them, that's when we do a financial plan, and we charge a small fee for that. So those are the only fees that we have.
So speaking of people that are getting laid off, they're getting fired because of AI, they have the 401k with the existing companies. Now they get fired. What should be the first step by not losing the momentum, and what they should do with the 401k that they have?
Good question. When you have a 401k and you leave a company, you have four choices. You could leave the 401k as is with the company you used to work for. It's a good choice. You can take the money out and put it into your checking account. Horrible choice, because you'll have to pay most probably penalties and taxes, but it's a choice. Number 3 is rolling it over from your old 401k company into your new company's 401k. And 4 is you can roll it over into an IRA and hopefully managed by a professional. Why do I say managed by a professional? One of the biggest mistakes people do, I don't know if you know this factoid, stock market over time returns 10%. The average investor only has a return of 4%. Number one reason, because they become emotionally attached to the stock market. That is the biggest thing that I do, is try to get the emotions out of investing.
How would you consult somebody to not make emotional trades or decisions when it comes to investing?
We look at the numbers. We look at why the markets are down. We look at why a stock is down. We look at why a sector of the market is down. What is happening today that is affecting the prices of today? If a company is a real good company that has good earnings, that has good technology, that has great potential in the future, and the fact that Wall Street doesn't see it for the next day or two, that's no problem. We want to buy more of that company. That's how Warren Buffett became the multi-billionaire that he is. He says, I'd rather buy companies that have cash on the books, not what Wall Street is talking about. Take the emotions out of it.
So Moshe, it's 2026. What does a person nowadays need to retire comfortably?
Great question, but once again, it all depends on the person and the individual circumstances. What is comfortable? Some people, comfortable is a $60,000 annual income. For some people, comfortable is $600,000 income. I usually tell people that whatever you were earning before retirement, you should go anywhere from 80 to 100% of that to still supplement your retirement years. So some people you'll need about $1 million. Some people might need $2 million. Some people could still live with 500,000 in savings. But you will need two things before you retire. Please listen to this. You will need to be financially stable. I can help you with that. The other thing that a lot of advisors don't speak about, and this is very important, you need to be mentally ready to retire. What do I mean by that? You will no longer be working 40, 50, 60 hours a week. That's a lot of free time you have now. What are you going to do that? You need a hobby. You need to have a great circle of friends and family. If you retire at 55 and all your friends are still working, what are you going to do all day? If you're married and your spouse is still working, what are you going to do all day? Do you like to go only golfing? Do you want to only do going out to eating in restaurants? If you don't have multiple hobbies, if you don't have multiple interests, that might be a problem. You will deteriorate mentally much faster. So you have to be mentally ready for retirement. That is important. Also, if you're planning on retiring before 65, plan on paying for health insurance. It is a big cost between whatever age you retire up until 65. Plan on that. So the two things that you really need to have before you retire is to be financially ready, and that everyone is individual, but we can help you at Greener Path. Very important is to be mentally ready.
So when you put together the financial plan, the roadmap for the next, 20, 30, 40, 50 years, depending on the situation, that's included in your plan is when to be ready and how to be ready for retirement.
100%. I've had some of my relationships, they've told me that as soon as they hit 59 and a half, that they can start taking money out of their retirement accounts. They want to start doing that immediately. Once we reach that age, and even though they were financially ready, mentally they were not, and insurance also comes into play. There are other people who thought that they were going to hit their goals by 65, 67, and unfortunately, financially, they didn't stay up to their commitments to put away enough money, and they had to work a couple of extra years to get to that number. Other people said, you know what? We're going to lower our financial obligations because we're going to live in a different state or a different environment that, their expenses are lower. I'll give you a great example. Being here in South Florida, we've got tons and tons of 55 plus communities. You could buy a cheaper home there. The real estate taxes are much less expensive. You have a community that will keep you mentally stimulated. So they said we could retire a couple of years earlier, have a little bit less in our bank account, but enjoy life a little bit sooner. So everybody is a little bit different. I have a question for you. You're a young guy still. You have a couple of kids. You have a wife, a lovely wife. What is your vision of retirement?
My vision of retirement, that's building enough passive residual income that I can live comfortably in retirement, where I know my money is invested into the right vehicles and there's a residual passive income that allows me to live a lifestyle that I want to live.
What kind of lifestyle do you want to live during retirement? That's the question.
That's the question. So I think I live a comfortable lifestyle right now by living in a beautiful Boca Raton, going out to beautiful amusement parks, restaurants, going on vacations a couple times a year. So I consider that to be a comfortable lifestyle. Being able to afford things for my family, for my kids, giving them the best education I can provide. When I retire, I want to make sure my family is set. My kids are out of the house. They graduate high school. They have a family of their own, where I can enjoy traveling more, where I can enjoy going and doing activities and going to events that I enjoy.
Nice.